So continuing, ideally, the longs that we took this morning was based on the idea that we took out the high time frame liquidity, right? So check, high time liquidity was taken, swept. In addition, we pushed into a daily fair value gap. This was the very first tap into this daily fair value gap that we had right there. That's confluence, right? That's narrative. Narrative of how price took out in the daily aspect, right? It took out sell side liquidity all the way down here, and after it took out this daily sell side, it started to shoot up with displacement and closed above here to potentially pursue even greater highs. So this was a daily retracement. Yes, it could have gone a lot deeper, but it had the justification that it wanted to then potentially push even higher. So we have narrative, we have a high time from liquidity swept, then comes the model itself. At the very moment in time, price did exactly what we're looking for. It did a raid first. I'm not sure if there was a divergence. In fact, let's fact check. Let's see if at that very instance in time there was a divergence with this or not. I think that was 945, 941. Yeah, there was 945, 941. There was a divergence. There was a raid and there was an SMT. That's a nice confluence. Right after the liquidity sleep, right with the context of everything. And what do we have following with that? Displacement with a market structure shift. We can see how firmly the candle closed above. No sort of wicks, no sort of retracement or deep candles down, no sort of slow moves higher. No, it was a firm pump with displacement. And right after, it had the PD rate to retrace into. Now, I wanted to go long relatively here. This was one of those scenarios it's an IO Fed, came back down, immediately shot up. I missed it. I didn't get my entry there. But, like I said in the bow analogy from way before, this is the ignition. Right now comes the development of price, of structure for the true direction of where it wants to go. Because this could just be a retracement. You don't necessarily know if this is a retracement to go towards a certain area and then sell off, or if this is a reversal. So what's the structure that develops? Practically a 5-minute 2022 model. So now we have a 5-minute raid, a high time frame liquidity being swept, displacement, and a nice PDA right here. Pure confluence, pure narrative telling me that there is high optimal scenario that we're going to now pursue high time frame liquidity. So if we look at it from this angle, now we have a lot more telling us that price is going to go even higher. So that was technically the entry model right there. The entry model was missed, but that it ended up creating new structure that led to even more reasonable that price is going to continue pursuing upside with a 5-minute entry model appearing right before us. That is why for me, I entered my longs here. We had the 953 root candle right here. So I was like, okay, I'll enter a decent sizing here, but with the complete mindset that if we come down here, I'm going to add more because that's the 5-minute busy. That's the 5-minute 2022 model entry. It did not come back down. It kind of poked a little bit, but it didn't come back down and tap the busy itself. So it was missed. But everything there led to, either way, the high probability 1-minute 2022 model right here, which was a nice example of how price should go and how everything should react kind of together. This is a nice way to see it, and I would say it's the best way to kind of do it as well. Ideally, you want to only take 2022 models as an entry to your idea once you have all of the context building up to it. You do not want to base an idea by itself completely on the 1-minute 2022 model, because again, it's an entry model. It's not like it's going to give you the saving grace direction just yet. Here, this by all means, an entry model that could have pushed here and then come back down here. But because there was a lot more context going for it, it pushed even higher, ended up making a 5-minute model, and then with that 5-minute model context, even pushed even greater. I didn't hold all the way to the top. Well, yes, I did. I held it at 100 points, but that's because we ended up invalidating bearish PD rays, which told me, okay, this is a potential reversal all the way to the external liquidity. But after that, I have no idea if this is going to be a true market reversal all the way through here. I knew the extent that it could go to, but I do not have all the guarantees because we had not made 15-minute structure until this point right here, which I think I went long again. So that's how you kind of want to practically use the 2022 model. Here's another example even of a short that after the 2022 model came true right here. So, I can't do that. We took out external liquidity right here. Now you could say that this is 1 hour sell side that's been taken out. So it's a high time frame liquidity being swept. Right after the high time frame liquidity has been swept, we ended up chopping a bit. Price made some highs, but at no point do you see any sort of bearish structure until a certain point, which is when price displaced lower and gave us this. Now, is this a 2022 model? Well, I don't see a stop rate, right? We kind of left this high here hanging. So with that high there hanging, let me look at S. This was right around 1108. Maybe we had a divergence. 1108. Yep, there you go. So ideally, if there's not a stop rate, you want to see an SMT. If there's not a stop rate and there's not an SMT, then the probability of success decreases. The probability that that is going to be the move decreases because the manipulation hasn't necessarily happened. In this case, this was the manipulation. S took the high, divergence. Nasdaq didn't take out the high, but because we already had the manipulation happen between the other index, it doesn't necessarily need to happen. Right after, where's the very swing low? Right here. We ended up wicking towards it, but price did not displace. So because it did not displace, I do not consider this a viable short at any point until I see displacement occur. Once price displaced right through and made that PD array for us, that's when you can consider, okay, this is optimal. In fact, this was an inversion as well, so there's a little bit more confluences right there. That is a lot more optimal to then potentially take for the downside. And we took that. Yeah, we took that on stream as well. That was the short setup that I took on the eval. I wasn't 100% confident in it, so I didn't take it on my fundeds, but we took it because it gave us the confluence that price was going to go lower. What about the long that I took where I faded you guys? If we go to the 15-minute time frame, this was during stream. Same thesis as everything else. 15-minute raid, price was swept. High time from liquidity, swept as well. 15-minute market structure shift with displacement. You see how everything practically starts to develop? First we started with a 1 minute, then we had a 5 minute, and now we have a 15-minute one. And in addition, this is a variant. This is a unicorn because we had a breaker and a fair value gap. When price was here, I thought price wanted longs. I thought price was going to try and push all the way up here, potentially. Not necessarily 100% because we also had the CB right here, but it was a potential regardless. So after that, we have our mid time frame model, we have our high time frame confluence. What do I see in the 1 minute time frame? I see that price did another sweep of liquidity. You could consider this was the rate right here, and then start to displace higher. Now, there's no market structure shift per se here because there's no swing highs, but we did end up close. This is also a wick. This wasn't necessarily a super displacement either, so it's a lot more iffy for sure. This is, you do not want to see your market structure shifts be wicks. You always want them to be firm bodies. So this was a lot more iffy, but it was still a model regardless to potentially push price up. And I saw that we had TMSR right there, which is why I took it here, and I held it to 1034 because it was a good area and a good target that price could potentially reach into. And obviously, well, it didn't take out the buy side. It was close, but it didn't take it out and then started to sell off right after. That's ideally how you want to use them as your confluences for your entries, not necessarily direction. You always want everything to confluence together for it. But what about invalidation points? Since it's an entry model, ideally it's going to be very clear when it invalidates. At some points it might close below the PD rate that you're using, and that's when you kind of want to base it out of your risk management for the soft stop. But true invalidations will look like this. Let's say this is a fair value gap right here. This was a market structure safe. This was a raid. When you enter a 2022 model, this is how your risk management should be with a hard stop. Assuming, right, it's the bottom because you're entering after high liquidity has been swept, or it's the top because you're entering with a high liquidity being swept. Your stop will always be the very bottom of the swing low right here. That's how ideally it should be. Because if price fails here and closes down here, then there's no reason to believe it's going to come all the way back up. Especially if, let's say, it took out a high time frame liquidity a while ago, right? Let's say this was a high time frame liquidity that was taken out. If it's doing this, that's telling you the price has unfinished business even lower against you. So let's say there's another sell side right here that hasn't been taken out. Well, if it invalidated my bullish model, then that most likely means that it wants to go for this first. That's how you can get that invalidation real simple, and that's how you can avoid getting trapped into little messes. I would say that's kind of everything to the 2022 model. Really simple. Saved you hours of watching a outdated mentorship with tons of rants. But if you guys have any questions, go ahead and ask. Hi, Tyrant, I'm new to the group. Where do you post these classes so I can watch again? Alright, Anthony sent you that. And welcome, Dan, to the server. How exactly do divergences work? They are manipulation between assets. This works in every single assets that there is. If there's even with currencies, with metals, with commodities, and other indexes, ideally it's when one makes a high and the other one doesn't make a high, or when one makes a low and the other doesn't make a low. That's the most simplest form to explain it. It's simply, imagine this is Nasdaq right here. Nasdaq does this low, but this is S. The divergence in between is how one took out lows and the other one did not. More specifically, this is also a sign of which one is stronger and which one is weaker. Because Nasdaq is making lows, Nasdaq is weaker. Because S is not making lows, S is stronger. So if you wanted to look for longs, technically, according to ICT, you would want to go long on S, not on Nasdaq. Now, I don't do that because I'm addicted to Nasdaq, but technically, that's what you would want to really do, and vice versa. If, let's say, Nasdaq fails to take out the high, but S took out the high, there's a divergence, but because this shows us that Nasdaq is actually the weaker one and S is the stronger one, we technically would want to short the weaker one, which is NAS. It would give us a better time than shorting a stronger index. So the SMT tells us a story of which index is stronger and which one is weaker, but it also tells us which one is doing like a manipulation that could potentially be like a top or a bottom. Because like I said, ideally we want to wait for manipulation to strike first to give us the sign that it finished doing manipulation and now it's ready to distribute. And sometimes we might be waiting, well, okay, well, I want to see the stop rate happen in NAS. The stop rate never happens and the move happens. And you're like, damn, if only, it did the stop rate, so I would have entered. But S did a stop rate. Then, oh, okay, S did a stop rate. I don't need to wait for Nasdaq to necessarily do one because S already did. You could watch for trendline liquidity, LRLR. That can definitely help. That would be, an extra confluence, right? Like if you enter a 2022 model and it's going against LRLR, that can be your draw to pursue. I always struggle with if I should enter when price retraces and touches the fair value gap or wait for the C. Feels like I always choose wrong. That's really kind of based on preference. Sometimes, because of how Nasdaq likes to knife around and do very aggressive moves, I like to wait for the swing high or swing low to develop in the PD array. I don't necessarily wait for the CE, but if you're trying to do a limit order, I know waiting for the CE can be the most optimal one. Or if you know, if you want to kind of like risk sink into it, you could actually do a starter position the moment it taps the PD array, and then enter more the moment it taps the CE of it. There's different ways to play around it. You just have to make the proper risk management for it. The entries won't always be perfect. I think if you have the right idea, you don't have to stress out about the entry too much. I don't really think too much on my entries. That's why I kind of tend to have like those bad averages that enter in a lot of drawdown at first. But I don't mind it because ideally it's more of if the idea is right, whatever your entry, you're gonna make bank on it. Alright, gap one. You should expect that it should serve as a stop rate for a potential top or potential bottom. It does not. Do not use an SMT for an entry though. SMTs are a confluence. Divergences are confluences for directions. They are not necessarily the oh it happened, I'm gonna enter. Because you don't know if oh yes it did happen, right? We are pushing lower, but then it does this. You don't know if it's gonna do that or not. That's why we want to rely on entry models for our entries, not confluences. That's the same reason why you can't just blindly slap a high time frame fair value gap expecting to have a reaction on it. Any other question? I guess I'm just too good at explaining, huh? Will you sometime do a psychology class on getting over the hump of passing evals easily to getting payouts? I feel like I take my best trades for passing evals. When I'm trading the funded account, feels like I'm more tilted, more scared, impatient. I'll be a trader guinea pig. I know there has a different curve passing evals. I just need to know how long the curve to funded is. Let's see. What could we cook here for some insightful wisdom? I definitely understand what you mean because there's different stakes, right? With an eval, there's different stakes that oh, it's just an eval. It doesn't matter if it gets hurt, kind of thing. But with a funded, it's more like this is real money. I can make money with this. I can lose money with this, and I really need this money, so I can't fail. And because of that, you get those nasty emotions. In a way, it is just kind of think of the funded as an eval, but at the same time, at least myself, I do tend to be more reckless with evals than I am with fundeds. So I would say, all right, there's also the opposite, like what happens to Greg. Ideally, when managing your funded accounts, you want to make sure you are implementing a risk where you're not exposing yourself to pain. There's a lot of times where sizing is an influence for that, right? You see your model, you see your setup, but if you enter a specific sizing where if your model or setup fails, you get hurt. And that puts you into an emotional state where, oh man, if I fail 3 more trades, let's say, you blow the account. And that makes you feel all sorts of nasty emotions. But let's say if you enter a sizing where, oh, I'm wrong, but I'm not hurt. It practically feels like if I just got pinched instead of getting stabbed. It kind of puts you in a situation where you don't mind being wrong again because the wound isn't deep, it isn't something that hurts, it's something that you can easily walk out of. I think that's the big thing that a lot of people do not really implement too much. It's the importance of sizing. Another way would be also you got it's really hard, but you have to start trusting your consistent results, in the sense of, if I make 100, 300, 500 points a week, and I know that even if I'm wrong, overall I am green on the week, then it's really that sense of just taking the leap and just putting a stop loss, putting a TP, and letting the trade do its thing. Because you have a system that provides statistically that you are more profitable than not, and the only thing that kind of stops you from achieving greater profitability is the fact that when you have that one bad day, you spiral out. For me, the way that I beated that was kind of forcing myself to abide towards certain rules. It was the having a light side. Like, I think I'm the lightest trader here. I take 1 or 2 micros in most of the majority of my trades, and I make a ton of points. But I always enter a sizing where I know I'm invincible with. Because imagine, like, I have a drawdown in the 150k accounts of 7.5k, right? With 2 micros, to hit 7.5k, it's practically fucking gonna be either take me a long ass time or practically impossible to hit in a day, unless I overtrade and scalp every single point perfectly in a session. And it's that kind of thing that if I put myself in a scenario where I'm most likely not gonna get hurt, then I don't have anything to worry about. For me, it's more of like, okay, I'm not gonna get hurt. I feel invincible. My system works so well that even if I have a red week, I have a green month. And if I trust that I'm gonna have a green month, I just have to disciplinedly, consistently repeat the same process every single time, and just believe that because I get green months, my account will theoretically be green, as long as I do not interfere with my emotions. And what makes us interfere with our emotions? Losing streaks, where we oversize usually, or over trading, where we want to catch every single move. Ideally, FOMO as well. These are kind of things that really stop you guys from really advancing. The countless amount of times where friends come to me like, oh man, I was so close to getting a payout, but I blew it because, I tuned into the PM session and I just wanted that one more trade. Man, it's crazy because this is, you gotta think of it like you're dipping your hand on fire every time you're trading NASDAQ. That's how I perceive it. NASDAQ is this pit of fire, and there's gold at the very bottom of it. And I know that if I put my hand there, I'm gonna burn my hand. But if I can just reach for that piece of gold, I just need to grab one and I'm fine. I made money, my hand slight burned, but nothing too shabby. I just burned my hairs off. Completely fine. But then, it's like, wait a minute. What if I get that extra piece of gold over there? And you try and reach towards it, and either you fall into the well of fire, or you end up severely burning your hand that when you pull it out, you start questioning, man, was this really worth it? Was it really worth, hurting myself to try and get this? You're exhausted, you're fatigued, or in some cases, let's say you grabbed it and then as you pulled it out, the pain was too much that you let go and you practically you missed the move, but because you were caught in choppiness and consistently closing your trades and opening and closing, you ended up red despite missing the move. Or if you caught the move, well, you still hurt yourself so much in the process of trying to catch it that you practically break even. So it is definitely greed, but it's also the desperation to want more when you don't necessarily need to expose yourself to it. That's why I always kind of preach that preservation of capital is key. Now, of course, there's a difference, right? There's a difference. Like LMT preaches that you don't want to stop maximizing your gains, and that's right. If the market is super easy, that you feel like you can read it so easily, things make sense, price is respecting, then you want to take advantage of that day. You definitely want to abuse that day and make the most out of it. But if you look at the charts and you tell yourself, man, this price action is miserable, then what the heck are you doing staring at the chart? You might as well just walk away after getting one good trade. And that's also a big thing to help grow the funded accounts, in my opinion. I always seem to start from behind and then feel like I dig myself out of a hole. You're so wise for someone a lot less half my age. I have so much respect for you. I believe. Yeah, I mean, honestly, it's trading experience. It's just I didn't read books. I was really lousy with fucking watching ICT too. I would always fall asleep on it. I would always lose focus. But what I always ended up doing was losing so many times. I've lost so many accounts. I've lost to the point that I've lost all my money and I had to get a job and I had to work for a while to get more money. I had to ask people for money, for help to continue trading. I lost so much that it reached the point that, you know, I had so much experience of losing that I was like, okay, well, how come I'm doing ICT concepts and I'm the one sucking while this retail trader on TikTok is making thousands just trusting some random line that doesn't make sense to me? And then it's like, okay, well, I gotta do something differently. What it is? Losing. If you learn how to lose, this is an easy game. Of course, it's a little bit frustrating, but it's an easy game relatively. You guys gotta focus less on winning and you guys gotta focus more on how to lose properly. Because that's ideally the bad. That's what everyone kind of forgets when they think of trading. When everyone thinks of trading, they think of how much money they can make. They never think of, oh, how much money can I lose, or how much am I putting myself at risk to lose this amount? How can I avoid losing this certain amount to try and make this? I think that would be the wisdom I can deliver for now. I hope it helped. My advice on how to manage it. It's clearly a difference in, you know, the nervousness, the anxiety that comes with trading the account where you do feel blood, but it's really just entirely based on how to go through the risk management with it. You might think, oh, sizing 1 micro in this account is going to take me forever to make green or to make some money out of it. But at the same time, you're building experience and you're putting yourself in a way that you're just not going to get hurt. So you'll be okay in the long run. Or you could do risk sinking as well. That's a nice way to divide the risk between accounts. I'd say risk sinking is a great thesis, an idea. Or in certain scenarios, right, where if you do want to continue trading throughout the day, you want to make sure to divide the risk adequately between your accounts. For example, I traded PM session today, but I was I distributed my risk adequately, so even if I had a wrong time in the PM session, I wouldn't be hurt. So I think you guys were there when I was kind of debating myself with, should I continue trading my fundeds or should I not continue trading them and just trade FTT? I saw that, I was green in everything, so I might as well just trade FTT and not risk losing the gains of my other fundeds. I had a good PM session. I made a good chunk of points. I could have made that amount of money in all of my accounts, but I only made it in FTT. Does it bother me? No, because I engaged into the market with the complete thought that I was going to be wrong, and I was comfortable being wrong in FTT and losing my gains in FTT, knowing that I had gains in other accounts. But what I wasn't comfortable was risking myself and losing everything I made in the good AM trades for no reason. And yes, if nobody has any other question, we can go over the Quant Tower as well. So does anyone else have any questions? Or something they would like to seek advice? What's the optimal sizing for 250k eval? I would say the best way to find the right sizing for a certain size of an account is to make it so you can have more than 20 wrong trades. I think that's definitely the best way. You know, you size to a way that you can just know that, let's say if out of 10 trades you get 5 correct or 3 correct, but the ones that you get correct happens to be a 1 to 3 risk to reward, that's a great system right there. That technically is a system that will still make you profitable. So if you know that you out of 10 trades get 3 to 4 trades correct, then you want to have a sizing where, let's say, at least in my opinion, you can be wrong 20 times, which means that you only need 8 trades to be right to be super profitable. That way, you don't have to stress out about the losses. That way, you don't have to put yourself in a scenario where you can't feel like you can't lose. Because another big thing is, you feel like you can't lose. Like you have to win. But if you put yourself in a sizing where mathematically it's fine if you lose, because if you just need to win like a few times, and you make it all back and more, then that's way better. For FTT to get the payout, we have to reach the drawdown amount. I'm pretty sure, yeah, because the drawdown amount is 5% of the account, so it would be like I have to make 5% of the profit of the drawdown. So I'm pretty sure yes. Pretty much what Greg said. All right. Then, if nobody has any more questions, I am gonna move to the Quant Tower section. It's gonna give you guys a little bit more time to think about something to ask. Alrighty, let's move on to the Quant Tower section. So, for this, I'm gonna need someone to record, if they'd be so nicely, because I do not know how to record Quant Tower with OBS. So I'm gonna end the recording here for this class,